Okay, let's just jump right in. If you've been out in the world lately, I mean, in the grocery store, checking your bank balance, or just noticing how much more a simple lunch costs, you know that feeling? It's that sensation of everyday purchases not stretching as far as they used to. And that's the palpable, the tangible impact of inflation at work, quietly eroding the value of the money you work so hard to earn. So we're here today because that erosion is a serious threat to your financial stability. And for the proactive learner, just, knowing about it isn't enough. We need actionable strategies. Inflation at its core is really just a sustained increase in the general price level of goods and services over time. A fundamental consequence. Your dollar buys less today than it did yesterday. The main tool we use to measure this is the Consumer Price Index, or CPI.
And that concept, it really needs to be crystallized with a number. Because the problem isn't theoretical, it's a concrete financial hit. Our source material gave this compelling and frankly kind of a terrifying example that illustrates the power of this compound erosion. So if an item costs $100 today, and we just maintain a 3% annual inflation rate,
Which feels pretty modest, right?
oh, very modest, that same item will cost you approximately $134 in just 10 years.
Wow.
Think about that. That is a 34% drop in your purchasing power over a decade. And the biggest takeaway here is this. Taking a passive approach, leaving your emergency savings or retirement cash sitting in a traditional low-interest savings account.
Which so many people do.
So many people. It means you are actively losing value every single day.
Well,
We need to be proactive. Our mission for this deep dive is to build a comprehensive financial shield.
Okay, let's unpack the immediate defense strategies first. Absolutely. The first line of defense against inflation. It isn't about some exotic investment. It's about establishing immediate control over your cash flow. We're calling this a strategic budget reassessment, and it goes beyond just tracking where your money is going.
Exactly. When prices are stable, a standard budget, it works fine. But when inflation hits, your needs portion of the budget,
Groceries, gas, housing.
right, it rises without warning, and that shrinks all the rest of your flexibility. That's why we have to start with the foundational pay yourself first principle. You must treat your savings and investments like a non-negotiable bill. They come out before you even look at discretionary spending.
I think the 50-30-20 rule is a fantastic framework here. 50% for needs, 30 for wants, and 20% for savings and debt repayment. But tell me, how does someone who is already struggling with those rising grocery costs, how do they make that 20% commitment happen?
It requires ruthless prioritization. And that brings us straight to debt. The single biggest accelerator of financial erosion, I mean, more so than inflation itself, is high-interest consumer debt, specifically credit card balances. These typically run in the, 20 to 30% APR range. You can't out-earn that with any safe investment. It's just not possible.
Well,
So the most actionable tip from the sources for that immediate defense is aggressive consumer debt repayment. We often recommend exploring things like balance transfer credit cards, the ones that offer an introductory 0% APR period.
because that stops the bleeding, basically.
It stops the bleeding. This is a crucial strategy because it lets every single dollar you send go directly toward the principal. You are literally stopping the interest erosion cold.
That's a powerful move. But let's also talk about winning the small battles.
Yeah.
Because they provide the mental clarity you need to tackle the big ones. I'm thinking about mitigating everyday expenses. We've all got those unused subscriptions or those automatic re-ups we just forget about.
Oh, those recurring charges are death by 1,000 cuts. It's not just the $15 streaming service, it's the 5 different $15 services. Our sources emphasize reducing these unnecessary expenditures, but they also get into smart household management. For instance, reducing utility costs using publicly available resources like those energy-saving tips from the Department of Energy is pure cash back in your pocket.
And the simple act of smart shopping, right? Comparing prices, choosing store brand items, and sourcing local produce. That can boost cost efficiency a lot. But I worry that focusing only on cutting subscriptions and saving $2 on electricity makes you feel like you are constantly playing defense.
That's a brilliant point. The sources are very clear on this. Cutting costs is essential, but it is a finite activity. To truly stay ahead of inflation, your income growth has to outpace it. We have to pivot from defense to offense.
So how do we shift that income needle?
You start by asking, if you're currently employed, you have to be proactive about negotiating salary increases or pursuing promotions that come with real raises. The data suggests that employees who negotiate tend to secure higher wages over their lifetime. You have to ensure your compensation keeps up with, or ideally exceeds, the CPI rate.
And if that's not an option?
If that path is blocked, Or if you need an immediate boost, the second strategy is exploring supplementary income. This could be freelancing, a side gig, or even developing a new in-demand skill that allows you to charge a premium. Generating multiple income streams creates a resilience that inflation finds very, very difficult to penetrate.
That transition is perfect. We've established the immediate defenses, we've streamlined our budget, attacked high-interest debt, put a plan in place to boost income. Now we shift from saving money to making money work harder for us. And here's where it gets really interesting as we look at investment hedges.
This is where we stop thinking month to month and start thinking long-term protection. The core strategy here, regardless of inflation, is diversification. If all your capital is tied up in one sector or one asset class, you just expose yourself to massive, unpredictable risk.
So we're talking about allocating across different classes. Stocks, bonds, commodities, and real estate. Why is that balanced portfolio so crucial specifically during inflationary periods?
Because different assets react differently. When consumer prices surge, traditional assets like long-term bonds might suffer as their fixed interest payments lose value.
Okay.
But during that same period, real assets often perform quite well. Historically, real assets are a classic hedge against rising prices. Think about real estate. It offers two anti-inflation benefits: the potential for property value appreciation and the ability to generate rental income, which typically rises with inflation.
Real estate sounds great in theory, but for a learner who isn't ready to buy a second house or is facing a high interest rate environment like right now, that seems like advice only for the wealthy.
That is a crucial question. Not every learner can or even should buy property right now. That's why the concept of real estate investment trusts, or REITs, is so valuable.
Right, REITs.
REITs allow you to invest in large-scale income-producing real estate without the liquidity constraint or the massive capital outlay of buying a physical property. It's an easy way to get exposure to that real asset hedge.
That makes the strategy so much more accessible. What about commodities? Things like gold, oil, or agricultural products.
Commodities are also tied directly to the cost of production and consumption, so they tend to appreciate during inflationary periods because their value is intrinsic and, tangible. Gold, for instance, is often seen as this historical store of value when confidence in fiat currency declines. So incorporating these tangible assets into your portfolio, even through commodity funds or ETFs, helps your capital keep pace.
Okay.
But we have to talk about a specific tool designed by the government to fight inflation directly: Treasury inflation-protected securities, TIPS.
I think TPS are often mentioned quickly, but the mechanism is really the key. How do they actually work to protect your purchasing power?
It's actually quite clever. TPS are government bonds, so they're incredibly secure, but they have a unique structure. Unlike a standard bond where the principal amount is fixed, the principal value of a TPS is actually adjusted twice a year based on the consumer price index.
So it moves with inflation.
Exactly. So if inflation spikes, the principal of your bond increases. You receive a fixed interest rate, but that rate is paid on the new adjusted principal. This adjustment helps preserve your purchasing power. It is a powerful, safe, and smart part of the strategy.
That clarity on the mechanism is really helpful. Shifting gears slightly, even with a strong investment portfolio, everyone needs cash available for emergencies. We can't put our emergency fund into TPS because we need that liquidity.
Absolutely not. And this is where maximizing your high-yield savings vehicles comes in. While we have to acknowledge that high-yield savings accounts, or HYSAs, might still lag behind high inflation rates, they offer significantly better interest rates than traditional banks, and they provide that liquidity you need for an emergency fund.
So it's the best place for cash you need to access quickly.
It is. And for money that you know you won't need for, say, 6 months to a year,
Then what?
then you look at certificates of deposit, or CDs. They offer predictable, fixed interest rates, often higher than HYSAs, in exchange for locking up the money for a set period. Think of it as a small, predictable yield booster for non-emergency cash. If we connect this to the bigger picture, we really need to focus on the long-term compounding effects of inflation, especially for retirement savings. We're talking decades here.
Right. And those decades require maximum tax efficiency. The compounding effect of inflation over 30 years can be devastating if we aren't proactive about how we save for retirement. So beyond simple market growth, what's the most critical strategy?
It's two things: consistency and tax advantages. Consistent contributions to tax-advantaged accounts like your IRAs and 401k are non-negotiable. The power of tax deferral, where you don't pay taxes until withdrawal, or tax-free growth, like with Roth accounts, means your money is compounding on a much larger base. That efficiency is a huge inflation hedge.
So you need to know the numbers.
You do. Knowing the 2024 contribution limits, $23,500 for 401ks and $7,000 for IRAs, plus the catch-up contributions if you are 50 and over, is essential. You should aim to max those out, or at the very least contribute enough to get the full company match in a 401k. I mean, that match is a 100% immediate return. It's instant inflation protection.
Speaking of retirement income, there's a clever strategy that far too many people overlook, perhaps because they don't grasp the powerful statistics behind it: strategically delaying Social Security payments.
This is one of the most effective and risk-free inflation hedges available to retirees.
The statistics are truly powerful here. If your full retirement age is 66 or 67, delaying your Social Security claim until age 70 results in these delayed retirement credits that boost your monthly benefit. And that final monthly check can be up to 76 to 77% more than if you had claimed at the earliest possible age of 62.
And critically, those delayed benefits, that massive increase in your guaranteed income stream, are then adjusted annually for cost of living, or COLA.
So they're constantly indexed against inflation.
It's an inflation-fighting machine. Now, of course, the decision needs to be influenced by personal health, longevity expectations, and other income sources, but financially, the benefit of delaying is almost always overwhelming.
But we cannot talk about long-term security without addressing the elephant in the room: healthcare. That sector's inflation often outpaces general inflation by a significant margin.
It's the stark reality. Healthcare costs can sink a retirement plan faster than almost anything else. And this brings us to perhaps the ultimate financial tool for those who are eligible: the Health Savings Account, or HSA.
Tell us more about the HSA, because the sources really highlight this as a premier strategy.
An HSA offers what we call the triple tax advantage, and it's why financial planners just love it. First, your contributions are tax deductible. That reduces your taxable income today.
Okay.
Second, the funds grow tax-free. And third, withdrawals for qualified medical expenses are also tax-free. No other account offers all three of those.
It's a powerhouse.
It is. Many people treat HSAs as short-term spending accounts for current medical bills, but the truly savvy strategy is to pay medical expenses out of pocket if you can, let the HSA money grow and invest it, and treat it as a supplemental retirement account for healthcare costs decades down the road.
This brings us to our final high-impact segment: optimizing the financial details that compound over decades. Things like smart tax and fee management. This is often the quiet, hidden source of financial erosion that most people completely overlook.
You're absolutely right. Inflation chips away at the top line, but fees and taxes chip away at your bottom line, your net return. If inflation is 3% and your expected return is 7%, a 1% management fee just ate 25% of your real gain.
That's a powerful way to frame it. So what are the actionable tactics here?
First, choose tax-efficient investments. This includes things like municipal bonds, whose interest is often tax-exempt, or index funds, which are inherently tax-efficient because they rarely sell assets.
Which minimizes those capital gains.
Exactly. Second, leverage lower long-term capital gains tax rates. That means holding onto investments for over a year before selling. Selling after 11 months means you pay ordinary income tax rates, which are much higher. This discipline dramatically boosts your net returns.
And the final piece of this optimization puzzle: the fees.
Ruthlessly minimize investment-related fees. This means choosing low-cost funds, primarily index funds, and using brokers that charge minimal or zero commissions. Those fees are a guaranteed drag on performance, and in a high-inflation environment, every fraction of a percentage point matters.
So what does this all mean for you, the learner? We've outlined a truly multifaceted approach to defending your purchasing power: taking prudent control over your immediate spending, strategically investing across asset classes with targeted tools like TIPS, and then diligent long-term planning focused on tax-advantaged accounts like the HSA. But financial life is dynamic, especially when inflation is high. This protection process isn't a set-it-and-forget-it plan. You have to periodically reevaluate your goals and your risk tolerance.
And remember the value of professional guidance. For those seeking tailored expert insights, consulting a certified financial advisor, someone with the CFP certification, can provide personalized strategies based on your unique circumstances. But if we synthesize everything we've learned today, the key insight that distinguishes the proactively curious learner from the passive saver is this. The greatest defense against inflation lies not just in cutting costs or earning slightly more interest in an HYSA. It's in the power of simultaneously enhancing your income through negotiation or side gigs and ruthlessly optimizing taxes and fees. This combined high-impact approach creates a financial cushion that is difficult for inflationary pressures to break down, regardless of what the CPI does next quarter. So I urge you to analyze which two of these high-impact strategies, income enhancement or fee optimization, you can implement this week. Take action today to protect your financial freedom tomorrow.